A little bit, very briefly about me. 25 years in the life insurance business and an investment advisor. And successful, maybe not the first guy in line, but I wasn't the last guy in line. And it was about 11, 12 years ago that I discovered this concept about 11 years ago. So after 14 years in my profession as a life insurance agent and an investment advisor, I discovered this concept by reading a book. Big, print, 92 pages, lots of blank spaces. It was an extremely easy read. But I was so angry after I read the book. And I got a little bit of a story behind there, but I really want to run through this. But I read this book after 14 years in my profession. And everything that I had learned from, Wall Street, all the insurance companies, investment companies that I worked with, which I'd already suspected, the playing field wasn't really level, which you already know all that. It became crystal clear after I read this book. So, it's conceptual. It's called the infinite banking concept. Have any of y'all ever heard of that? Okay. It's getting pretty, I wouldn't say wildly, a lot of wild exposure, but it's getting more and more exposure. So, the insurance agent or the financial guy, he might know something about it. But most of the time, if you're in a room full of people and you know anything about the infinite banking concept, you're automatically the expert because no one else in the room knows anything about it. And about 90% of the guys who think they know something about it really don't know come here from Sikkim about life insurance and how to become your own banker. They just know how to sell life insurance. And I'm not cracking on anybody in particular, any company. I'm cracking on my industry. Okay? All right. So a little bit of a challenge I feel like I have. All right. This is conceptual. I firmly believe that if you don't understand the concept, the details don't matter. Right? But if you do understand the concept, then the details don't matter. All right? But since the details typically is your money, I understand it's extremely important. All right? So I'm going to go over some details, and I'm going to go over the concept and then bring in some numbers, right, and try to make some connections there. Encourage questions. If it's a burning question, I'll answer it right now. If we could wait till after I finish and Ed finishes, we're going to answer a lot of your questions and be happy to take and address all of them. But, unless it's a real burning question, if we could do that at the end, I would appreciate it. Okay. Now, there's got to be a comparison, or I like a comparison, so I'm going to start with qualified retirement plans because we all know and own probably qualified retirement plans, right? And I'm mainly talking about the traditional plans. And really the reason I like to talk about this is because the majority of America, the majority of their money, their wealth is in their primary residence or qualified retirement plan. Now you think about that. How liquid is real estate? Well, it depends on the market and how many loans you already have outstanding. How liquid is your qualified retirement plan? And I understand you may have self-directed IRAs and self-directed Roth RIAs, and we're going to talk about those. But if you even think about that for a minute, the only reason you have a self-directed IRA because you don't trust that financial guru that's 3,000 miles away that keeps losing you money and charging you fees, right? You want to control the investment with real property that probably appreciates with a cash flow, right, to outpace inflation. Okay. Now, the average guy on the street, the all-American family, the majority of their wealth is in qualified retirement plans in their primary place of residence. Now, they've separated themselves from the majority of their wealth. Sure, you can borrow money against 401ks. You can, take home equity loans, cash out refis and all that. But you've essentially separated yourself from the majority of your liquid wealth. So now you're beholden to some third-party lender, credit cards, banks, credit unions, the hard money lender or whatever the case may be. Right? Okay. All qualified plans beg three questions. Number one, are taxes going to go up in the future or are they going to go down? Up, of course. Look, I got a 1913-1040 form, right? The first year of the Internal Revenue Service was the first year we had to pay income tax. I'm sorry?
First time we had to fill one out, right?
Yeah, right. Now look, I know these numbers are small, but down here in the lower quadrant, you could earn $20,000 a year in 1913, income tax free. And then between $20,000 and $50,000, you only had to pay 1% interest, or 1% in tax. Okay, and then it graduates up to 6% cap. If you earned anything over $500,000, you had to pay 6% interest. All right, now I'm not going to try to beat you up with numbers, but the equivalent today is $120,000 in income you could earn income tax free. All right, so tax brackets change, deductions change, carryovers, exemptions, exclusions, all of that changes. But the net amount of money that we're paying out continues to go up. All right, and if you remember on the qualified retirement plans, they came out in the 80s, the Keogh plan, you work hard, save your money, save it for retirement. You'll probably be a millionaire and in a lower tax bracket when you retire. So you might as well defer all the taxes till that time when you're in a lower bracket, right? Y'all remember that in the 80s? Well, tell me which one isn't true. Are you a millionaire? Hope you are. You're in a lower tax bracket? Yeah, probably not. Right? Okay. Second question. Would you rather pay taxes on a little or a lot? The seed versus the harvest? The seed. And the sideline there is if we had a linear rate of return, if we got 5% year over year over year over year over year, every year, it wouldn't matter if you paid up front or in the end. But you know as well as I do, returns don't come that way. You could be up 10% one year, you could lose 20%. I'm sure none of y'all have ever lost money in a real estate deal, right? All right, so if it is not linear, then it does matter, and you would rather pay taxes on a little versus a lot. And then that also presupposes that the underlying investment of the qualified plan even grew. Right? Okay. And then here, I love this one too. Is a dollar worth more today or in the future? Today, it's always worth more today. And here's the way I like to illustrate it. When you were a child, how many candy bars could you buy for $1? A handful. All right, you should have been buying apples, or, this is what happens, right? How many candy bars can you buy for $1 today? One if you go to the dollar store, right? Of course, you should still be buying apples. Now look, $1 is always worth more today. And if you think about that for a minute, inflation, right? The expansion of the money supply. We was talking about Austrian economics earlier. When the Federal Reserve prints money, they're expanding the money supply. The result, that is inflation. The result is what we see, the rising cost of goods and services. Okay? All right. So inflation is going on, devaluing the dollar. So now the world is obsessed with a rate of return. Right? You got to take more risk. If you're young, you got to take even more risk. Right? So we're obsessed with the rate of return in the lowest interest rate environment ever. Right? While inflation is devastating the dollars that we get to keep after taxes. Right? I mean, in that way, y'all are doing some real estate so you can get the higher rate of return and you can control the deal. Right? And really, if you think about that, the only time, most of the time, when you lose money, it's because you lost control of the deal. Or, we're all human, we make bad decisions, but even those most of the time are based on either bad information, misinformation, or, emotional greed or fear. Right? But you typically don't lose money if you're educated in your real estate while you're here to get educated on real estate, right? And maintain control. Okay. Now look, the qualified plans violate those three truths, right? Taxes are going to go up in the future. You're going to pay taxes on a larger amount if the underlying investment is successful, right? And the dollars you take out at distribution, whether you want to take them out or not, you're going to take them out in a qualified plan. The IRS is going to tell you when, how much, right, and how often. Those dollars that come out are worth less than the dollars you put in because of inflation. And now here's another on a 401k, and I'm not saying you're self-directed IRAs. If you look at a 401k over a working period of time, the average family working hard for 30 years saving money in a 401k, they're paying what they think is 2 and 3% in fees. It's probably 3.5% by the time you get the fees in there, all the fees that are disclosed in the prospectus, and then in the quarterlies, and then in the annual statements, right? Plus the trading fees. All right, after fees, a working accumulation 30-year time period. We can even go 20 years beyond that to the distribution phase of a qualified retirement plan, about 30% of the account value is going to be eaten up in fees. About another 30% is going to be eaten up with taxes. And then out of that 30% that you get to keep is going to be devastated by inflation. All right, but this is where America is told to put all their money. Right, and I'm telling you that once you look at it in the whole truth, you know, the good, the bad, and the ugly, man, it might not be that good a deal. But even if we consider Roth IRAs, look, I'm 53 years old. You know, most of us don't have big account values in a Roth IRA because it's limited on what you can put in, and they haven't been around for 30 years, right? But even all of the dollars that come out of a Roth may be tax-free. They're still worth less than the dollars you put in because of inflation. And then your income levels, like I said, potentially phase you out of that. Conversion's always a taxable event. Well, that's, you know, maybe good, maybe not. Depends on the timeline. All right? But the regulations and the cost are becoming more and more onerous on self-directed IRAs. And you know what? It's not going to get any better. You know, Congress isn't going to wake up and say, oh, you know, we've made it really too hard on these self-directed IRA owners. We ought to lighten up the regulations, right? It ain't going to, you know, it's only going to get worse. Okay, here's a closer look at the timeline. And I've got a guy going to work or a person going to work at, you know, 19 and a half, and they're saving money in a qualified retirement plan. That means for the next 40 years, they've effectively locked up their money. Because if they withdraw it, there's a 10% penalty, and then all of that is ordinary income tax in the year it's distributed, right? And I understand if you have a 401k, you can do a loan, but you know that's limited, 50% of the account value up to $50,000, right? And they're going to tell you you're going to pay it back over a 5-year time period. You tell me who controls that loan then, right? And then if you leave your job, it's a distribution, right? Who controls that loan? It's not you, right? It's the IRS. Okay. But now, once you turn 59 and a half, you enter into this magical 11-year period. You can take as much out or as little out as often as you'd like or not. There's no penalties. Just ordinary income taxable. All right, well, that takes you to 70 and a half. In my example, I'm letting you live to age 100, right? So that next 30-year time period, you've entered into another penalty phase. If you don't take out your required minimum distribution, that's going to increase every year, you could be taxed or penalized up to 50% of what you should have taken out but didn't. And I didn't misspeak. You know, a tax, a penalty, a tax, same thing, right? Okay, so that means 80 to 85% of the time the plan owner is in a penalty phase. Right? They're not in control. Okay, and then on the bottom here we have 45% of all plans liquidate fully or partially prior to retirement. And then in 2009, 10, and 11, that number went up to over 70%. Those are fidelity statistics. Now, why would anybody sacrifice and put money into a qualified retirement plan for their retirement and then liquidate and pay all the fees and income tax in 1 year? Why would anybody in their right mind do that? Right? Yeah, because life happens, right? There's a medical issue, they're moving, they lost a job, or there's education. Life happens, right? And then, once that's done, then you got to start the whole program all over. All right? Okay, that's qualified plan. And I promise I have easy questions, right? I only have one trick question in the whole deal, right? You tell me who that plan was designed for. All right, who do you think? Of course, all y'all know it was designed for Uncle Sam. That's nothing but a long-term savings account for the Uncle Sam. And if you think about that for a minute, in the 80s, the IRS said, you know, that our people aren't saving enough money for retirement. Social Security is only meant to supplement retirement. We need to encourage them to save money for retirement. So we'll give them a tax break today so they'll save money and have money to retire on. No, they give me a tax break today, but they deferred the taxes. They deferred the calculation. They didn't give me a break. If they really loved me or had my best interest in mind, wouldn't they just lower the taxes to begin with and let me save for retirement? Yeah. And then all those fees you're paying on Uncle Sam's third? Wow. Right? Because a third of that's theirs. And can't y'all just see that, and look, I love my country. All right, I'm American through and through. But can't you just see the IRS, you know, the next banking crisis or whatever crisis comes along? I can see the IRS saying, you know, you're a true-blooded American. Your country's in trouble. A third of that money's ours anyway, and we need our money now. So we're going to exchange those for a qualified retirement plan or a guaranteed retirement plan. Right? I mean, can y'all see that possibly happening in our future? Look, that's the largest pool of money that exists in the world. Qualified retirement plans in America. Right? So, could it happen? I don't know. They confiscated gold in 1933. Right? Now I know there's some debate over that. No, they didn't confiscate it. Oh, by force, they forced you to exchange gold for Federal Reserve notes. I don't know what you call that. You can call it what you want. I call it confiscation because it was by force. There was no choice. So, I mean, they have a history. It wouldn't surprise me if they needed money. They would eyeball the largest pool of money that exists on the face of the earth. Right? Okay. Now, if you consider qualified retirement plans, when you put your money in, you restrict the control, use, and liquidity of your money. 80% of the time, you're in a penalty phase. And then, of course, you know there's nothing new in America. The consumer pays for everything, right? You pay all the fees, even Uncle Sam's. And then, of course, you assume all the risk, right? But the younger you are, you know, the more risk you can tolerate. Well, let me ask you this. Would you agree with me that a definition of risk could be the probability of loss? Is that a fair definition? Okay. So if I'm young, I can assume more risk or probability of loss. And the longer I have my money exposed to the probability of loss, I'm supposed to win that game. Does that make sense? It doesn't to me. All right. Okay. So the comparison, qualified retirement plan sets the largest pool of money to this concept, the infinite banking concept. This book was printed in 2000. There's a new edition that's got 2 additional pages, printed in 2010. The author is going to be here next week. You have an opportunity to meet him if you want. I would encourage you to, if you could schedule it, get it done. He's 85 years old. He's not going to continue traveling the country after this year. So you have an opportunity, but it's very limited. Okay, and this is the book that I was telling you about that I read 14 years in my career, successful career. Read this book, 92 pages, big print, lots of illustrations, and it was a complete paradigm shift in my thinking after I got over the anger of discovering what you could really do with dividend-paying whole life insurance. And that's about the hardest challenge that you have considering or looking at this concept, getting past the word life insurance. Because I know what comes to your mind, and I'm not talking about that. You have not seen this concept or these types of policies. Okay. However, there's 2 foundational concepts for this concept to make sense to you or for you to be okay with it. You got to be okay with these 2 concepts. Number 1 is you finance everything you purchase. You either pay interest to someone else when you formally finance, or you give up interest you could have otherwise earned when you pay cash. So either you pay someone interest when you formally finance, or you give up interest you could have otherwise earned. And there's no exceptions to that, whether you recognize that or not. Richard Kenelon discovered that in the 1300s. Right? Okay. What am I talking about? Now, you may not can see these numbers, but let me share them with you. I'm using a 30-year time period. Okay? And I'm using a 5% rate of return. So I'm not talking about a get-rich-quick scheme at all. But if you could earn 5% on your money and you made a $30,000 purchase, whether it was an automobile, a vacation, a second home, real estate, whatever, piece of equipment that made your business more profitable, I'm only looking at that $30,000 that you paid cash for whatever you purchased, right? Well, you could have earned 5% on that money, but you don't have that money anymore. You have whatever you purchased. But if you had the money over that 30-year time period, it would have grown to $129,658. But you have whatever you purchased. So we're going to subtract that cost, $30,000, out of that, and then we isolate over a 30-year time period for paying cash for a $30,000 item. Does that make sense? All right. You can't earn interest on that money anymore because you bought something. All right. If you retained that $30,000, it would have grown to $129,000. You didn't keep your money. You exchanged it for whatever you purchased. So over a 30-year time period, you lost $99,000. All right. And so my point here is this concept has to make sense to you. You got to be able to wrap your mind around it. But with this concept, you can capture the equivalent of all of that lost interest, income tax free, in a private asset that you own and control, that operates like a pre-engineered tax-free trust. All right? If you could do that, if you could really do that, would you want to learn how to do that? All right, and if it's a no, you shouldn't buy a book, a DVD, and come here, Nelson. But if you would like to learn how to do that, you should come and spend 4 or 5 hours with the man who created or discovered this concept. Okay, now the second foundational concept that you have to be okay with is the banking process. All right, like Jimmy said earlier, we're all busy, right? We're all busy. I have about a 30-minute PowerPoint that's titled, "We're all busy, but we're all banking." All right. Okay, so here we're going to look at the banking process. And I'm using a $100,000 deposit into a bank, and I'm illustrating a 4% rate of return is what they're going to pay you on that deposit. That probably dates this PowerPoint, right? Okay, but you put it in the bank, they're paying you 4%. Do you know what the bank is going to do with your money? You know they don't lend their money. Their money is Tier 1 capital. It's on guaranteed deposits, on guaranteed payback schedules. They use your money as a basis to inflate money. They really don't even lend your money. They loan the money that they created out of thin air on your deposit. Right? Now they take that money that they created out of thin air, right? And they create loan portfolios. I've created 6 loan portfolios. And I put interest rates on each one. Automobile loan portfolio, I've got 8. I know you can watch TV today and it says you get 0% interest, 1% interest. That's another form of discounting. You know, that's like General Motors, GMAC, before they came Ally Bank. GMAC, right, was the most profitable arm of General Motors before they sold it. Now you tell me how a finance company can be so dang profitable at 0% interest. Right? Okay. So I put 8 on there. Well, I got to tell you, every one of us passed automobiles on the roads on the way over here that are financed at 8, 9, 10, 11, 12, 13, 14%. All right, I just put 8 on there. Then I've got 5% on the home mortgage, 9% on line of credit. I've got 8% on an equipment portfolio, 8 on construction, 6 on commercial real estate. So you put the money in the bank creates money out of thin air, and they put that money out in portfolios, and that portfolio repays them. You know, as soon as the car's paid off, somebody goes and buys another car, right? And another car. Oh, and the average family, they're going to finance about 20 cars over their lifetime. And I'm just telling you that's been my experience. You know, I'm married. I buy a car every 10 years. Oh, my wife, she buys a car every 8 years. Oh, we have kids. We bought the first couple of theirs or helped them in some way. I've been driving for 30 years. I'm probably going to drive another 30 years. You put all those numbers together, it's about 20 cars. Okay, so and my point here, I got a couple of points I'd like to make. Are we okay with all those interest rates? Is it okay if I use them? Since this is a pre-printed PowerPoint, right? All right. So I'm just going to total those up. They're paying you 4, they're earning 44. So the question here is, how much more is the bank earning on your money than you are? Come on, somebody be brave. Give me a number. 40? 30, 40%. 40 is the most common answer, right? It's simple math, and it's wrong, right? And I'm wrong too, but I'm saying at least 1,000%. Actually, the bank was making more, closer to 1,800%. Well, let's go through the math, okay? How did I get there? How did you get there? How did people get to the most common answer? Well, here's the most common answer. Well, they're earning 44, they're paying you 4, so it's 40. How did I get to 1,000%? These are the keystrokes. Simple, You don't even have to have an HP 12C or a big fancy calculator. Simple calculator. 4 times 1,000% equals 40. All right? Are we okay with that math? All right, you can do that math any way you want. There's several ways to do that math, and I'm not playing games with numbers at all. All right. Now, we all know that the bank is printing money out of thin air. And you can't do that, right? You'll be in Leavenworth, Sing Sing, or wherever they send you now, right? Okay. But look, every one of y'all drove over here in an automobile. No one in the room, as a matter of fact, is going to sleep in the rain unless they want to. I don't care if you stayed in a hotel, somebody paid cash for that hotel, or there's a mortgage on that hotel. Right? Okay. Probably not the first house you bought. Oh, y'all real estate investors, y'all own more than one house? Are you kidding me? All right. So we've all had lines of credit, credit cards. We've all done equipment financing or hard money lending, construction loans or student loans and real estate loans. So you can't print money out of thin air. But you can put money in an entity that you own and control and then use that capital while it's earning interest and dividends forever. Forever. You can use that capital while it's still earning interest and dividends to go finance everything that you were going to finance anyway. Oh my gosh, you finance everything you purchase. You either formally finance and pay somebody interest, or you pay cash and give up interest you could have otherwise earned. No exceptions. Right? This isn't complicated so far, is it? It's pretty simple. Right? Okay. So that's called the velocity of money. When you put money into motion, it's velocity. Right? Okay, here's take a side note. 1921 Tulsa. Okay? Y'all ever heard about the race riots? I mean, I was born and raised in the South. 1921 Tulsa. You should go to YouTube and do some research on that, right? Or see what's out there. There's some good, there's some bad. Look, y'all remember Andrew Jackson, president? He was a bad guy, right? Because Trail of Tears took all the Indians from Georgia and Florida, marched them all the way across the country, settled them in Oklahoma, right? Well, he put a lot of black people on that Trail of Tears too. Okay. So that means that there's a high population of black people in Oklahoma because of the Trail of Tears. All right. So now we're getting out into about the late 1880s, 1890s. The black community in Tulsa, Oklahoma is called the Black Wall Street of America. Right? And it's in the Greenwald district of Tulsa. There were hospitals, schools, movie houses, grocery stores, everything. They were a thriving community, right? Very, very wealthy little community. All right, so there's trouble broke out in the 1920s, racism, whatever it was. I mean, I'm not trying to make a race issue out of it. I want you to consider the economic fact of what was going on in 1921 Tulsa. All right, they were the richest city in Oklahoma, not because of oil, but because their money never left their community. Right? They didn't shop outside of their community. Their money turned over 60 to 100 times in their own community before it ever left their community. Right? Now, money's not wealth. Right? Wealth is goods and services, real property, real assets. Money's what you exchange to get those. Right? So their money never left their community until it had turned over 100 times. So they were accumulating the goods and services that money was getting them. Does that make sense? Okay. So the race riots broke out in 1921. They about 65 square blocks of that city got burnt down. I mean, leveled to the ground, and about 500 or 600 people were killed. 2,000 or 3,000 people left, probably more than that, 4,000 or 5,000 people left. Some people stayed, tried to rebuild, and they never again could reach that stature. And the reason was because of Jim Crow laws. After 1921, the Jim Crow laws started loosening up. Then they could shop outside of their community. Just like a little child, you tell them, no, you can't have that, you can't do that. That's what they focus on, and that's what they want to do. Right? So as soon as they could shop outside of their community, they did. And when they did, their money only turned over 2 or 3 times in their own community before it left. All right? So they weren't wizards of Wall Street at all. There's an economic lesson in there, and thanks for letting me take that side note. Okay? All right. This is the only trick question I have, and if I back up, what I mean by that If you put money in an entity that you own and control, and then you continually use that money for things you were going to buy anyway, your money would never leave your personal economy. Right? You could finance the car you're driving, you could finance the car your wife's driving, and the next one, and the next one, and the next one, and the next one. You could finance the next house you're buying, and the next one, and the next one, and the next one. All right? So it's not big profits on any item. It's running your money, the same money, through your personal economy and maintaining control and getting the wealth from that. Does that make sense? Okay. The trick question here is, who'd you rather be, the banker or the borrower? It depends, right? All right. Let's look at this. The borrower has a ferocious need for capital. Right? Nothing happens unless there's some money exchanging hands, right? So if we're going to do some investing and we don't have any money, we're not going to do any investing. You know, there's a ferocious need for capital on the borrower. Well, you tell me who controls the loan, the banker or the borrower? The banker controls the loan. Well, who makes the profits? Right, well, he can make some profits if he's successful. He gets paid a good salary. You know, he's a gopher at a financial institution. They kind of take care of him, right? Did you know your bank pays dividends? Has your bank ever sent you a dividend check? No. You know why? Because the dividends go to the owners of the bank, right? The most profitable individual here is the owner of the bank, and he's not there. That's why it's a trick question. So you really want to be the borrower, the banker, and the bank owner. Because you have a need for capital, you want to control the loan, and you want to make all the profits of that financing deal. Not the deal, but the financing deal. Let's look at General Motors again. You know, if General Motors makes a truck, right, they're going to be profitable, right? Manufactures a truck, they're going to be profitable. My God, you can spend $80,000 on a truck today like in a blink of an eye. Right? The dealer that sold the truck, he's going to be profitable too, right? And the salesman's going to get paid, or he's not going to show up for work. Well, the financing institution, whoever they are, is going to be profitable too. Out of all those people, who do you think is the most profitable person there? The bank, the financing entity. And that's true for 6,000 years, right? Okay. So I want to look at a spending method for a moment. And I just got a baseline of 0. You know, most people in America today don't have any money. So if they go buy something, they got to borrow it. So they go immediately into debt. Right? And then somebody tells them what kind of payment plan they're going to be on. And the penalties if they don't adhere. Right? And they're going to pay that loan off. Right? Well, they don't have any discipline either. That's part of the reason they don't have any money. So the next purchase, they're going to use somebody else's money. And that somebody's going to tell them how and when to pay back and how much. All right. Same goes for the next purchase and the next purchase and the next purchase and the next purchase. You know, y'all are ahead of the curve, right? That's why you're here, right? Because you're ahead of the curve. I mean, this is where most of our neighbors are. All right. Now look at the cash buyer. He doesn't want to pay anybody interest, right? But you know you've got to have cash to make a cash purchase. All right. You got to save up some money somewhere, whether systematically or sporadically, to make a cash purchase. But as soon as you make a cash purchase, you don't have that money anymore, right? Okay. So he does the next purchase the same way, right? Because he don't want to pay anybody interest. And that's how he does his buying. Well, looky there. Both those guys wound up at the same place. Okay. If you put money anywhere, in any kind of an account, and I don't care what it is, you know, because I'm talking about banking, the infinite banking concept. You know, words have meaning and words have power. Okay? I married a beautiful girl from West Des Moines, Iowa. I'm from Fort Worth, Texas. You know, in the wintertime up there, it snows like crazy. It's colder than all get out. And then when the wind blows, the snow piles up against buildings and barns. Y'all seen that before, right? What do you call that pile of snow up against a barn? Snowdrift. Snowdrift? Have you ever heard the term snowbank? Right? And then if I went canoeing, right, I'm floating down a river, what do you call a pile of dirt on both sides? The pile of dirt on both sides of the river. It's a riverbank, right? We probably all fish from the riverbank, right? Now, if I'm going to go get blood tomorrow, where would I go? A blood bank. So bank can be an aggregate of any one thing, right? Okay. The capital stock of a bank is money, right? All we're trying to do is pile up money. Now, the root word, the etymology of the word, I'm told a bank is bench, because money changers worked off benches. 6,000 years ago, when worshipers would go to the temples to pay tithes and homages, the money changers worked off a bench. So it's a flow in the movement of money. If we look at Webster's today, and we look up the word bank or banking, it's going to talk about deposits, withdrawals, loans, loan repayments, right? The movement of money. So banking is a process of money moving. Purchases, deposits, withdrawals, loans, loan repayments. Does that make sense? And you can bank with anything. You can bank with a CD, right? You can bank with a margin account. You can bank with cash. You can bank with anything. Banking is a process. And that spending pattern put on an account that has a rate of return. Any account that has any rate of return creates an exponential curve if you don't interrupt that, right? If I put money into an account and there's any kind of rate of return, I've created an exponential curve. And if you don't interrupt that, it will compound, exponentially, right? The exponential curve. Okay. Life insurance, structured for cash or not, has a rate of return, and it's exponential. So if I put a lot of cash in there, I'm going to earn interest and dividends forever. And if I put enough cash in there to go finance what I was going to purchase anyway, now I can bank with this life insurance policy. Does that make sense? Okay. Now here's the spending pattern, right? I'm going to try to tie it all together right here. There's an exponential curve, and oh my gosh, that's the same spending pattern. Save up money, make a cash purchase. That could be a loan repayment, cash purchase. Loan repayment, cash purchase. Loan repayment, cash purchase. Savings accumulation, cash purchase. I'm changing the names of a cash flow, right? Words have power, words have meaning. To save up money, if you put money in a bank, it's a deposit. If you put money in an investment company, it's an investment. If you put money in a life insurance policy, it's called a premium. All right, now if I've got a bunch of money in there because I pay premiums and most of the premium went to cash, I have access to cash. Now if I withdraw that cash, I'm going to make a purchase. I'm just going to do it through a loan from the life insurance company, but I'm not taking money out of my policy because I'm not going to interrupt that exponential curve. It's going to still earn interest and dividends, compounding forever, and I'm just going to make loan repayments. Make a purchase, loan repayments, purchase, loan repayments. Does that make sense? That's pretty simple, isn't it? It's really not complicated. It'd take a real financial guru to complicate this stuff. All right, by God, they can do it. Okay. I've got a 39-year-old male. This is a life insurance illustration. These are the real numbers, right? A bona fide life insurance policy. Typically what comes to mind, but I'm using high premium, right? I'm not trying to put pennies in, so I only get pennies out. If I want access to capital, I got to put some money in there. Does that make sense? Okay. So I got a 39-year-old male. He's just standard. And I'm illustrating $20,000 a year premium payments. How much can you put in your 401k? Oh, how much can you put in your Roth IRA? So I'm illustrating a $20,000 premium. By the end of the year, he only has access to $500. But he's got $1 million death benefit. This is typical life insurance. Right? This is typically what comes to mind. This is what I'm talking about. Not that one. Right here. I've got to click it. There you go. How about these numbers? Same guy, 39 years old, same premium, $20,000, but he puts $20,000 in today. He has access to $13,000 in about 60 days. All right? Man, that's a loss of liquidity, about $7,000. Who would do that? I'll show you who would do that and why. Right? All right. So now he doesn't have $1 million in death benefit. He's got $13,200 in cash value at the end of the year. Okay? Now this is where, you talk to somebody who hadn't read Nelson's book, who's never been exposed to this concept. You're going to say, why in the world would you, put $20,000 in life insurance policy? You know what kind of commission that insurance agent made? Is the insurance company, who are they? Are they related to AIG? I can't believe you do that. I'm going to quit hanging around you. But you didn't listen. $20,000 in the next year, $20,000 in, there's a $13,000, almost $14,000 increase. So you put in 40, but you have access to $27,000. Okay? All right. Now it takes this guy about 7-8 years before he put money in. All the money he put in, he has access to. Does that make sense? There's a startup cost. You can't get around it. I can't get around it. But what I want to show you here is that after 7 years, he's put in $140,000. He has access to $130,000. Then he never pays another premium ever. He just uses that $130,000, whether he's buying real estate, cars, vacations, whatever he's doing. Okay? And if he bought appreciating, cash flowing assets, then he could pay that premium if he wanted to. But I'm illustrating this, no premium, after the 7th year. All right, and he winds up with a death benefit by the time he's out here, and it's not even on here. He winds up with $700,000-800,000 in death benefit, and he winds up with $300,000 or $400,000 in cash values if he doesn't do any banking. But if he banks, all of those numbers grow. He'd wind up with $600,000-700,000 in cash value, $800,000-900,000 in death benefit, plus all the real estate that he had, that he financed from this life insurance policy with. Does that make sense conceptually, kind of? All right. So, if he had $130,000 outstanding in loans, if I had $130,000 in cash value and I went out, how many properties can you buy with $130,000? 1, 2, 3 on the other side of town? And then you tell me if there's an outstanding loan on the policy and I'm playing honest banker, I'd want to make a loan repayment. If I go buy real estate, you tell me who pays the taxes, who pays the insurance, who pays the repairs, who pays the mortgage, the principal and interest of that real estate that you own and that I would invest in. Who pays that? Come on, y'all, you're in the real estate. Not you. You're responsible for it. The tenant's paying it. Right? All right. Now, if I got a cash flow coming in, I got to put it somewhere, right? And I'm telling you, there's no better place to put money than a life insurance policy designed this way. If I build capital there, and I've been successful with that capital, creating cash flows, now I've got assets, a place to put the money, a cash flow to run that cash flow through. Are you with me so far? Okay. Because on this next illustration, this is the very same illustration. I'm just saying, look, you don't have to pay the premium if you don't want to in the 8th year, but if you did, here's what would happen. And why would you? Well, because if you've got all those cash flows, they've got to go somewhere from the real estate investment. And I'm not trying to cloud the picture. Y'all, my goodness, y'all are in real estate. All right? I'm encouraging you to think and combine what you're doing with real estate with this infinite banking concept. There's no greater financial tool, strategy, method on the face of the earth. All right? So look what happens in the 8th year. And this premium is $66.25, $6,625 a year in the 8th year. You got a renter in a property creating a cash flow, right? And net, after you made the loan repayment to the life insurance policy, if you made part of that cash flow a premium, $6,000 in the 8th year, there's a $21,000 increase in year 8. You put in $6,600. There was a $21,000 increase. Oh, I'm sorry. $22,000 increase. That's not right. I'm at the wrong line. I was scaring myself. $6,000 in, there's a $10,500 increase. 66 went in, $10,005 increase in cash value. Now, where can you do that? Where can you go write a check today for $6,600 and see a $10,500 increase? I don't either. All right. But this guy was 39 years old. Let's go out to 55. He's still paying $66.25 if he wants to, and he should. And if he did, in that year, there's a $16,000 increase. Now, if I put money in there, I have access to the money, and I'm going and buying cash flowing, appreciating assets, real assets, that I own and control. Real estate has a step up in basis. It's preferentially tax treated, right? Real estate, well, so is life insurance. But I've created those cash flows. I can run those cash flows right through this life insurance policy. Now I've got a life insurance policy with a big old honking death benefit. I got a lot of cash value that continues to increase, which allows me to go buy more property. This is a private asset, right? You can't sue me for this. You talk about a protected asset. There's unlimited protection in Texas on death benefit and cash value. It's a private asset. I own it. I control it. It's hands off. Then you've got the real estate. It's a private asset, cash flowing, real property. All right, when you put those two together, it's, like I said earlier, haven't seen anything more powerful on the face of the earth. That's a bold statement. All right, and I'm just trying to get you to consider, look at, take a deeper look at this concept without prior content. Take what you think you know about life insurance and what you've been told about life insurance your whole life, throw it out the window, right, and discover a banking method using a product called life insurance structured this way. And then, you know, I can illustrate policies all day long. When you see what's going on with a dividend-paying life insurance policy, you can't put enough money in fast enough. Thanks for watching. If you enjoyed the video, leave a like, and if you think it was helpful, share it with a friend. If you want to see more videos like this, then subscribe down below and click the bell icon so you can be notified when we release new videos. And we are releasing new content all the time. Don't miss it. Thanks for stopping by.